On the morning of March 19, 2026, the Indian equity markets opened to a bloodbath. Within a matter of hours, 12 lakh crore rupees, roughly 140 billion US dollars, were erased from investor portfolios. The benchmark Sensex plummeted by nearly 2,500 points. The Nifty 50 broke through the 23,000 support level. At the same time, the Indian rupee hit a record low of 93.21 against the US dollar. Local attention was momentarily diverted by a domestic shock, the abrupt resignation of HDFC Bank's chairman over ethical disputes. While the bank's stock tumbled, this boardroom crisis was merely a side note to a much larger systemic collapse. India's core macroeconomic indicators were strong, but the market was defenseless. The sell-off wasn't driven by local fiscal policy or domestic earnings. It was the arrival of an external shockwave. The actual pressure on Mumbai's markets was building 1,500 miles away, in the energy hubs of the Persian Gulf. For weeks, military tension between Israel and Iran had been escalating. On March 18th, the conflict entered a new phase of economic attrition as Israeli aircraft targeted processing hubs at Asaluya, damaging up to 20% of Iran's South Pars natural gas field. Iran retaliated by launching missiles at Qatar's Ras Laffan industrial city, the world's largest liquefied natural gas hub. The strikes forced a force majeure, suspending supply contracts. Production halted completely, instantly removing 20% of global LNG supply. This physical supply chokehold caused immediate panic in the commodities pits. Brent crude oil prices spiked violently, surging above $116 a barrel. The destruction of physical pipes and storage tanks transformed into an inflationary impulse, moving at the speed of light toward Western central banks. That impulse reached Washington, D.C., as the U.S. Federal Reserve prepared its latest policy decision. With oil prices threatening to reignite domestic inflation, the central bank took a defensive stance. Fed Chair Jerome Powell announced that rates would hold steady between 3.5% and 3.75%. More significantly, the Fed revised its 2026 core PCE inflation projection upward to 2.7%. Core PCE tracks the prices of goods and services purchased by consumers, excluding volatile food and energy costs. The Fed's dot plot slashed expectations to a single rate cut, signaling elevated borrowing costs. This turned the US dollar into a magnet for global capital. Investors pulled liquidity out of emerging markets like India, forcing a sharp currency devaluation. The Fed's attempt to insulate the American economy from energy costs effectively weaponized the US dollar against the developing world. By the time the shockwave returned to Mumbai, the Indian economy faced a dual crisis, a physical energy shortage and a sudden evaporation of liquidity. India's heavy reliance on gas imports makes it uniquely vulnerable. As soaring import costs crushed the rupee to a record low, foreign investors dumped $8 billion of Indian equities, fleeing toward the safety of the strengthened US dollar. Direct corporate casualties were everywhere. Petronet LNG and GAIL India saw their shares plummet by up to 12% as their literal physical supply from Qatar was cut off. Domestic economic growth was irrelevant to the outcome. The market was broken by the inescapable math of the global energy monetary nexus. The March 19 crash represents a rational repricing of a world where infrastructure warfare is a baseline reality. Investors are no longer just hedging against military headlines, but against the physical destruction of the global energy grid. This creates an impossible choice for emerging market central banks. They must now choose between raising interest rates to defend a plunging currency or keeping rates low to support domestic growth, knowing that neither option can stop an energy shock. In this environment, a local portfolio is only as secure as the pipelines and tankers that feed it. Geographic borders no longer define financial risk. The global energy grid does.